Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the worlds of business, finance and investing to try and get a grip and a handle on just what's going on with this pandemic and how we need to position our own portfolios to survive with minimal damage and hopefully to thrive in the new economy coming out the other end. Now, if you're one of Hargreaves Lansdown's 1.2 million clients in the UK, you're going to be very familiar with my guest today. He's been their head of research for more than 2 decades, and his face is on just about every research report that they send out to you. He's also written a book called Effective Investing, and he is, of course, Mark Dampier. Mark, welcome to Money and Me.
Thank you, Graham. Much appreciate being here.
I think you're joining us from the beautiful Mendip south of Bristol. I could think of worse places to be locked down.
I feel quite spoiled, actually. I can walk out onto the Mendips almost straight away, and there's hardly anyone here. That's the amazing thing. I very rarely meet a walker when we go and walk the 2 dogs. So I am very lucky. I'm not in a London flat or anything like that. So yeah, I feel very fortunate.
Great. Okay. Well, gosh, there's just so much to talk about. Let's kind of start at a macro level. Just get your take. There's been a couple of months to sort of reflect on things now. What do you see as the sort of economic impact of COVID-19, and how is that translating into the financial markets?
I don't think we've had all the consequences by any means, and I've listened to some of your other guests as well, and I probably agree with people like John Steppick along the way, except that I'm much more of a deflationist, at least first. So I think we're going to get a bout of deflation, which could be quite ugly in terms of markets later on. But I'm actually quite bullish at the markets shorter term, and have been. I've kind of called it as a melt up, if anything, and everyone's looked at me as if I was completely mad. Given what's happened, I think the consequences are just going to be long and drawn out. It's a bit like 2008 in one aspect. That we were going to have sub GDP growth for years, which we have, and in a way, the virus is a catalyst, I think, or is a catalyst for problems and good things. We've heard about some of the good things, speeding up of digital. And the reasons why people like Microsoft and Amazon are moving more forward. So I think that's all very important, but I think it's kind of, we all know about it. And I think that's the danger. We've had 10 years of growth markets. Growth has been the only thing in town. Let's be frank. With lower and lower interest rates, they're not interested in kind of value. And so growth is just, it's like the Matterhorn if you look at it on a graph. And why will that stop at the moment? Because actually outside, we're not going to have a rate, interest rates aren't going to go up. And so I think that momentum will, to a degree, carry on for a while yet. But the virus, I think, has made other stocks quite interesting, the sort of value stocks, because they've been completely pummeled. Now, you can't tell me, well, you can tell me, but let's take something like Carnival, which is, I'm not a stock person, and so this is no stock tip in any way whatsoever, but I don't think people are going to stop cruising. So if Carnival can stay in business, I think there will be a number of colossal winners from all this, because there's going to be some bankruptcies, but by God, the ones who stay with it are going to clean up. So don't write off the less sexy, can I say? Because the sexy stuff is all the Amazons, the stuff that's been moving, and all the sort of value. It's kind of really rather boring. It's old world, old economy. Do we want that anymore? But you can't tell me that people aren't going to travel again.
Okay, but you say you correctly called that melt back up in the market. What was it that you think drove that melt up? Because obviously, still as that was happening, all the economic news was still like Armageddon squared. Well,
I was around in '87, so I saw the stock market crash then, and it came as a hell of a shock. As a younger person then, it was a mighty shock for me, and I think this has shocked people. The speed of the fall again. It was kind of very similar, but all the time I said to my team, I was saying, well, the Federal Reserve, the central banks have got to come in, and they've got to come in a really big way. I think one of the problems was the central bank, the Fed, in the US was a bit slow, off the mark. it caught up and did. And I said, once they come in, and I think they will, I think it'll steady the whole ship, and I think the market will go up. And I may still be wrong, but I think the market's going to go up further from where we are today. We might see some, nothing goes up in a straight line. We might see some consolidation, a fall, a 10% correction easily. But I don't think we're going back to those lows that we've seen for a while. And in fact, I think the market could, I think the S&P could actually go to 4,000. And I think it's back, and I do think it's on the basis of a lot of central bank action and the fact that this is a one-off. I think it's a one-off hit. So quarter two, the quarter we're in now, all the economic stats are absolutely horrible. You don't need to know they're all obviously, you're going to turn off most of the economy. You know that all the stats are going to be bad, but from here on, they ought to start improving. So I actually am not that bearish shorter term. I think I'm probably a bit more bearish longer term.
Yeah, well, that's what I was going to come back to, because obviously you started out with feeling that you're kind of deflationist, and there's a lot more. I think it's going to take quite some time for the full effects to be realized.
Yeah, I agree.
In the week we're recording this, Hertz has just gone into bankruptcy in America, a huge company. So picking the winners and losers is going to be a challenge. So what is it that you think might then steer things towards the market going down in perhaps the medium term?
Well, we've got $250 trillion of debt in the world today, perhaps a bit more than that. And then you could probably add quite a lot of leverage on top of that. We've never had anything of that size before. Now, maybe we survive that, but I actually am not sure at all. And it's interesting you mentioned Hertz, because I was going to mention it, but you got there first. But isn't that a potential example of deflation? So Hertz goes bust, and what's Hertz's biggest asset? Well, it's got to be cars. And, well, what everyone is leveraged up to the hilt in cars. So they could potentially just swamp the American car market with even more second-hand cars. That is really deflationary. I think the Fed might decide to ease back later on in the year, and I think that could cause a problem because it has in the past if they try and bring back, and I think that could cause a deflationary spiral. I hope I'm wrong, by the way, and I'd be happy if you come back to me in a year's time and said you're an idiot, because I'd be really glad, because I find that really scary, because I think the markets would take a much bigger fall. So not 35, 36%, and we could see a fall in excess of 50% then. And I'm desperately hoping that I'm wrong. And then I think we get into that deflation part. The central banks pour even more money then. I think the balance sheet of the Fed, which I think is about 7 trillion now. Well, you can double that. You might even be able to treble it. Then at some stage we do get an inflation problem. But I think that's further down the road. So I know John Steppe was talking about it, and I think he's right. I just think it'll take a bit longer. Those consequences just take a bit, they just don't snap. We just don't go from one to another. But do I think we could get double-digit inflation sometime this decade? Yes, I do. And that is going to cause real problems for investors, because I'm old enough to remember the 70s, and I wasn't an investor in the 70s, but I can remember inflation at 25%, and I can remember friends getting mortgages, which they thought was sky high. Absolutely. I've just got a £5,000 mortgage, Mom. My God, how am I going to pay that? And within 2 years, they'd had 8 pay rises, and the mortgage was suddenly, well, who cares? But in the last 20 years or so, you take out a £200,000 mortgage, and 10 years later, it's kind of still 200,000. It's really painful still, and you probably haven't had big pay rises. So that's difficult. So I think the next decade is going to be completely different from I'm lucky. I'm a horrible baby boomer who started in the markets at the low point, pretty much. I mean, in '82, the American market was yielding 5.5% and was on a PE of 7, just to give you an example. So I'm lucky. The millenniums, they're looking at a completely different. They're looking at right at the top, as far as I can see. I mean, US Treasury bond yields in 1982 were 14%. I mean, wouldn't you love to start from that premise today? And you're not. So I just think, in a way, I think it's just horrible to advise people right now, because the consequences I mean, there's a lot of macro stuff going on, but as you know, with macro, you could be years out of time with it. You can, so you just got to keep an eye on what's going on.
So you touched there on bonds, which of course, 14.5% sounds like a kind of wet dream these days. But why have they stayed so popular when they're getting like 0 to negative? I could get more money stuffing my cash under the mattress. So why do people still buy these bonds?
Well, part of it's regulation. So remember, regulatory pensions, whatever, huge amounts of money have to go in there. I suppose governments have obviously been major buyers as well. But actually, my argument over the last decade, because I've been a bond fan pretty much for the last 9 or 10 years, because I didn't think interest rates were going to go up. So if you think back, I think virtually every year someone's called it's a bond bubble, some of the famous fund managers. And I thought, but it's only a bond bubble if the environment has suddenly changed. So if you suddenly think that interest rates are going to dramatically move up and bonds are where they are today, you think, well, we've got a problem, or where they were even a couple of years ago on 2 or 3% yields. But it wasn't going to change. I just didn't see that environment changing. So I couldn't see, even though I didn't think bonds were great value in the sense of an historic sense of it, they weren't going to fall in value. If anything, they were going to rise in value, which is what we've seen. And I think today, why are they buying it? Well, partly, as I said, because of regulatory issues, but also because a lot of people are scared. They're really scared. And US Treasury bonds were bought really heavily. I still think they might go negative, and they're around about 0.6, a 10-year, because the environment is scary. And if you get a deflationary environment, then they'll still work well. So people are more worried about the return, of the money coming back to them rather than the actual return they get in that sense of the word, I think. And that's why they've stayed popular. At some stage, you're quite right, I'm sure there's going to be a terrible bloodbath, because people have been told for years and years how bonds are low risk. But if interest rates went up, if the long bond went up about 2%, I think that's probably a capital loss of about 35%. That's not great. So that's why I say how hard it is to advise people today, because you're walking on eggshells. It feels like, you're on the edge of the fence. It could go that way or that way, but I don't honestly know. Let's be truthful. None of us actually know for sure.
I guess one imagines that because of all the debt they're taking on and creating as part of the stimulus program, etc., it would be in the government's and global government's interest to try and generate some inflation, the way our friends in Japan have been trying since the late 1980s. Do you think that exactly?
You've got 3 big problems, haven't you? You've got the debt that I just mentioned anyway. So trying to push interest rates up and trying to do anything like that, it's going to be really difficult. Then you've got technology, which has basically been deflationary. The internet is definitely deflationary, or it has been so far. And then you've got something that hardly anyone seems to talk about, and that you've had people talking about it before, and that's demographics. And I think that's a huge trend in the West, in the Europe, Italy, Germany, States, but less so. But you've got a whole generation. Well, I'm 63, so I'm not far away from retiring. So when people retire, generally, they don't spend so much money. And despite the millenniums thinking that my generation has got fantastic pension plans, unless you basically work for the public sector, you probably haven't. I only know 2 of my friends who've got a final salary scheme. The rest of them have got, like I have, a personal pension. And I'd swap it for a final salary scheme any day. I can tell you, I'd much rather have the assurance of that. So you're going to spend less money. And what's the biggest driver of economics in the US, UK, Europe? It's consumption. It's consumer consumption. It's 70% or so of the economy. So if you're going to start turning me off, I still spend money, but I'll spend money on what I call sort of experience and service. I don't need any more tables. I don't really need loads of new fridges, freezers, all the sort of stuff you get when you're younger. And that's what we saw, my generation buying things, doing all that. we're not gonna spend money in that sort of way anymore. So I can't see how that's not deflationary on the whole.
But also, I mean, you bring up the subject of pensions, and I'm a year ahead of you, so I'm very much in the baby boomer generation myself. Now, since the pension, I think A, we haven't saved enough across our lifetimes, and then B, we've had all of these nice freedoms from Mr. Osborne, and it's obvious people are taking too much out of their pensions or the drawdown or whatever. So, I mean, is COVID-19 going to be perhaps the trigger for what will turn into a pension crisis for baby boomers?
I kind of feel the crisis it may be, but it's sort of going to be there anyway, because I mean, drawdown, I know people, I understand pensions freedom in that people, it's their money. I get that completely. My problem is that most people aren't equipped, I don't think, to act emotionally equipped as well. And I think it's really hard. I mean, many years ago when I was advising and working with people, I actually managed some drawdown contracts. I'm going back 20 years ago because you could do drawdown a long time ago, and I couldn't sleep at night, kind of worrying about it. And now you come up to retirement, do you really want to spend half your time looking at the stock market every moment saying, well, can I afford to take some money out today? Can I do this? Can I? Not really, but that's what you've got to do. And I'm just not convinced that most people are doing drawdown because they don't like the annuity rates. They've had pretty much 10 years of a bull market until recently. And I really worry about what happens if there's a really big fall. I'm not even counting what we've seen in some respects. It's not quite as bad as you say at the moment, by the way, because people aren't taking that much out, because a lot of the people retiring today have got some kind of final salary scheme as well. So their private pension is a bit of a bonus on top. So it's not, but gradually, as that's going to change, because more and more people haven't got the backstop of some secure income. And I think it's quite scary, because this pension pot's going to try and have, you've got to make it last 20 or 30 years. And the Australia experience doesn't look very good to me. Like they start running out after year 15.
Right.
I mean,
So could you see annuities coming back at some point, even though obviously this kind of interest rate environment, the returns are going to be pretty pathetic?
Well, yeah, in some ways. I mean, it's a psychological thing. People don't want to do an annuity because they have to kiss goodbye to the capital. That's always been the problem. Even when annuity rates were at 10%, people didn't really like it. So it's not just that level, but I think having a secure income or a growing income in retirement, now that people are living considerably longer, is something that shouldn't be just sort of wished away or washed away with something. I think it's really important. So I have to say I don't have a solution to it, because what I'd really like, I would suggest, is if you've got a big enough pension pot, you'd annuitize some of it, in the ideal world, and say, look, these are my expenses, so I need, I don't know, £10,000 a year to pay everything. So why don't I annuitize that? So I'm fairly secure, and then I've got the rest of the money. But actually, you need a huge pot to do that. And I mean over £1 million. Well, you can't even do that. You can barely get up to £1 million now. You get into all sorts of trouble, and not many people have got that size anyway. And so yes, I think there's a potential huge problem coming down the next decade, because as I said before, I think the next decade could be just a very different kind of investment background to the one that we've had pretty much over mine and your working lifetime. And that's what worries me.
Okay, well, one of the very definite things we can point to as a result of the pandemic has been the cancellation or reduction of lots of dividends, even from some of the so-called dividend champions.
Yeah.
So the people that have been relying on and have built up an equity income type portfolio have really been struggling. And there seems to be some discussion as to whether these changes might become permanent rather than bouncing back to previous dividend levels.
Well, I'm going to hold up my hand and say I'm at least partly guilty by suggesting that a dividend, or what we call a natural yield, would be a better route. I mean, because on the whole, you shoot me now, but on the whole, I tend to think that dividends are a more secure route, or they have been for all my lifetime. It just goes to show what can suddenly happen. But I'm not here. I don't think you're going to write off equity income. I think that there has been a problem before. Again, I call the virus a catalyst. Maybe the catalyst of the problem here was that companies were paying out too much. So I see a rebasing. Now, for those who are doing drawdown and pensions, I hope that they've got 2 or 3 years of cash reserves, because that's what we normally suggest. That's what I would do. So if your dividend has been halved, let's go straight 50% because it's easy. You should at least be able to use your cash, because I think by 2023 things will hopefully start to look better. Having said that, of course, if there's a macro scenario of high inflation by then, that's not good anyway. But you can't sort every problem out. But so I don't think it's right to write off dividends. And in fact, globally, I think the UK's had more of a problem. But do you know, a lot of global funds are actually keeping their dividends where they are, or actually 1 or 2 houses probably will see an increasing. So maybe the answer has been to just spread the money out more globally. And I think the UK has had a perennial problem in that, certainly around the FTSE stocks. The FTSE 100 really has done nothing for 20 years. Let's be frank. And why? Because it's dominated by, you could say, old economy, oil, particularly, which is, probably going out in the long term. You've got banks, well, they're a real problem. So there's not. I think it's got barely 1% in technology. The S&P's got 25%. So I think the bigger stocks have got the problems. What amazes me, though, is that the UK is often written off by that. But when I see fund managers, VCT managers, small cap managers, even the mid cap managers, there's lots of great companies to invest in. There's lots more lower down. I think the great trouble with the UK is we seem to, I think actually Justin Stewart mentioned it in his thing, we seem to flog them off too soon. So we never get to a Google or an Amazon, because we probably sell it to the Americans by the time it's a sort of £2 billion company, because the entrepreneurs are thinking, great, thank you, that's enough to retire on, that's my bit. They haven't got the ambition to drive it forward. I don't know, something goes wrong, which is really, really frustrating. And the FTSE 100 at the top it's not getting new entrants. There's nothing exciting, is there?
Okay, so you mentioned the idea of more global diversification. Are there some particular markets you think people should take a look at if they're wanting to try and get a better kind of level of income and dividend?
Well, Asian markets are on the whole quite good, mainly because there are a lot of family businesses, and family businesses like their dividends, and so they'll try and protect them. So I think sort of that, and I think perhaps we've all been too greedy with the starting yield. We need to perhaps rebase lower, especially with where interest rates are anyway, and look for a growing. I try and say to fund managers, look for a growing income. Don't look for the headline, because what I want on retirement, if I pack up work, I've been used to a monthly wage, and on the whole, I've had some pay rises along the way. What you don't want is a static income on retirement. So you want dividend growth, because that's effectively your pay rise. Because that's what what most people are going to have to depend on. Because I can't see what else produces much of an income. That perhaps is the biggest problem we have for the baby boomers, that they're really dependent on stock markets, and that really is a bit scary, because we know they go down, and that's where I think emotionally are we able to cope with that.
Okay, and obviously you've talked about potential fear of heading into more significant inflation as we go on. When you combine that concern with very low, returns on bonds or cash, does that make gold a more attractive investment for at least part of your portfolio?
Yeah, but you can't put very much in it. That's the problem. I know the usual thing is, you could put 5% in, can't you? That's a sort of standard response. And yes, it'll help. I've got some gold. I've probably got about 4%. Does it make a difference? Well, it helps a bit, but I've got 90% elsewhere. So, and I can't really put 40% of the portfolio in gold. I'm not that brave, because I could be completely wrong. And I'm talking mainly about gold mining shares rather than just, I mean, you can put physical gold, I could see that as well, but mining shares, well, they're not exactly known for their sort of non-volatility. What can we say? It's a pretty wild ride. And I think from a professional investor's point of view, you'd be taken out and shot if you even tried to do anything like that. So there's the problem. I don't think you can do an awful lot. I think if we had a really big inflation, I'm going to say that one of your better bets might be just in the short term to hold cash. Because although you're saying, well, the cash will go down because of inflation or whatever, it won't go down as fast as shares and bonds. And at some stage, you'll reach a level where you actually want to invest some money. So that's what scares me, that we get a big inflation. And I mean, 4 or 5% isn't big inflation. Shares could cope with that. Bonds wouldn't, I don't think, but shares could. But 10% plus, oh God, the ramifications on the share market, just, you won't want to be around, will you, to see that? Not many companies are going to be able to sort that out.
Okay, well, I mean, the other thing that's obviously a favourite amongst British investors for a long time now has been buy-to-let property. What are your thoughts on where that's heading?
God, I've made myself really popular on buy-to-let over the years. I've never seen the attraction of it, I'm afraid. I'm not a property person, by the way. So I think you live in it and enjoy it. And I have looked at it from time to time and thought, what am I missing something? And I remember looking at a flat in Bristol a few years ago. And, I did it recently, actually, down in Devon, just to think, am I missing out? I can't make the numbers anymore. The yields are too low. You might get 5%, which might sound really exciting. Then take away agency fees, take away tax, take away all the other bit, and maintenance, which is quite big, you find. Tenancy void every now and then you might get, tenancy problem. You probably end up with barely 1%, 1.5%. And what do you get? A load of hassle. I mean, someone's going to ring me at 2 o'clock in the morning to tell me the boiler's broken. Well, I have to admit that I'm not a DIY person. So the thought of that is just awful. So I think buy-to-let's a business, actually, more than an investment. But I'm not and I think people do it more because they think property values are going to go up a lot. And the last 10 years, they haven't moved very much. I know you could point to a few city centres, obviously London and a few northern towns, but outside those places, prices have hardly risen at all. I would say, look at the nationwide as an index. If you go back 10 years from 2008, there's a big rise. Go from 2008-9 to now, they're pretty much flat. They haven't done very much. So I don't see buy-to-let as being some magical thing anymore. If you could get me a yield of 10%, I might be more interested. But I couldn't stand all the maintenance and all the hassle over it. I consider that basically the more possessions you have, the more hassle you get. And so property is just hassle, when things go wrong.
Okay, well, I think one of the things you've already touched on, and I think one of the things that the audience watching us would be hoping for is to try and get some clarity and some ideas on where we go with our kind of asset allocation going forward. When you see people like some of the top investors in history struggling at the moment, Warren Buffett's just had to take billions of losses on his airline investments. You sort of think, well, how do we decide what we're going to do? What do we do? Do you just let this all happen, or is there? Well,
Warren Buffett's got a lot of cash. So which people don't talk about. I know about the airlines, and he's had a awfully, he's had a terrible period of investing, but he's also been actually cashing in a lot as well. He's got a huge war chest of money, and I just wonder whether the canny person is just thinking, this is all going to end in tears, and I'm going to be the one who can then just sweep up the real great companies at really low value. So I wouldn't write him off. And I genuinely struggle with your question because I'm not absolutely sure. I'm glad that I'm not an advisor, a direct advisor, going out to see clients directly now, because it is quite a struggle. The conventional low risk portfolio would be sort of 60% equities and 40% bonds, which by and large over 40 years has been pretty good asset allocation. But if we go into an inflationary environment, that's going to be a complete disaster. And and that's what sort of bothers me. So in trying to answer your question, I'm not sure, I'm just being honest by saying I'm struggling. So what can I say that I've done personally? Well, I haven't done an awful lot. I've got quite a bit of cash for myself. I've got funds like M&G Macro, which is sort of currency and bonds. I bought a few more corporate bonds because actually the Fed coming in has actually backstopped that. And actually that's quite a secure income for the time being, as far as I can tell. I have got equity income, which took a real dive, but is beginning to sort of recover. So I've got a spread of assets, but I've got a lot of cash. So it's not a great answer. It's not perhaps a very exciting answer, but I just feel like I quite like, I mean, I think Claire Barrett mentioned it as well. It's quite nice to have a bit of cash behind you. And people talk about 3 or 6 months cash behind you, your salary or whatever. Well, I've always said, especially if you work in finance, you should have a lot more than that, because you're doubly geared to the market anyway. You're invested in the market and you work in it too. And it's great when it all goes up, isn't it lovely? But when it goes down, my God, it's a low. It's a real low. But having cash just gives you so much more flexibility. And I think it's so underrated, because unless the banks all go bust, it's not correlated with anything else I can think of. I accept it's a low return at the moment, but inflation's not going anywhere. If anything, as I said to you, I think we're in deflation for a moment. So I'm not losing in any great way, and I can bide my time a little. So I don't mind having that bit of cash. Otherwise, I've probably got pretty much across the board, Asian income. As I said, I like the UK still. I know I get shot for that because it has been awful, especially since the referendum in 2016. But I think UK is probably at a 30-year low in valuations, which I find interesting. If I had a worry, it's always going to be America. And so it's all very well saying find another area. But if you think the States is going to take a big plunge, I mean, look what happens. Everything else goes down even more. So I've got to say to investors, if you are seriously bearish of the States, you should be pretty much bearish of most markets, because if the Dow falls tonight 25%, what's going to happen to world markets on Monday? Damn well they're all going to follow. So where's the diversification in that?
Okay, well, as we come towards the end of our time together, the final sort of topic I want to touch on, and I think it might be relevant to what you're saying about having global exposure, is the sort of active versus passive management argument, because a lot of active managers have struggled to beat the market, and people have had decent returns from passive funds.
Yeah.
So, in your book, and when you spoke at one of our events, you talked about the strategy of masterly inactivity. And I just wonder whether, if you're widely diversified in passive funds, do you just sit back and let this all happen?
Well, maybe you do. I mean, one of the best funds it's been the lifestyle funds on Vanguard. And what do? They just sit there and they've been in that right area. I don't know over the next 10 years whether they'll do the same. And I know I'm kind of known to be an active champion. I understand that, but I get a bit tired with the passive zealots as well, because actually I don't think any of us do any good, because I think the most important thing is to get people invested, and arguing amongst ourselves whether passive's better or active's better, or an investment trust or a unit trust, I think just makes people think, well, the experts can't make up their mind, why should I even be here? I think passive's had a great time because we've had a one-way bet, if you want, for 10 years. We've had large stocks on the whole outperforming, which is great for passive. And we've had one style performing, and I think that's been pretty good. I've never been a person, by the way, who thought that if there's a downturn, active does better. Why should it, unless the fund manager is brilliant and goes 75% in cash? Well, they don't do that, and you get taken out by doing that anyway. So a rapid change of if momentum style investing suddenly disappeared out of this market for a while, I think you might see quite a radical change. I mean, the last few days have actually seen value suddenly outperforming, but we've had these spurts before, and it's a bit like what I said about bonds. Have things changed? Interest rates aren't going to go up. which would probably help value. But what would help value, I think, in the short term, would be a treatment or a vaccine for COVID. Because suddenly a lot of those value stocks, which have been absolutely hammered, I think could rise 2 or 3 times in many cases, and that could change things. And I think there will be a treatment or a vaccine at some stage. But in the meantime, we're just going to have to live with the virus, because there's no way around it. But everyone's working on it so hard that I cannot believe a treatment alone would actually do it, I think. Because if I could take a few pills and that would take the worst out of it, I think people would accept that as they accept most other things, as they accept flu and whatever. But at the moment, it's the fear of the unknown that's scaring so many people. And I think that's got to lift.
Okay, well, I mean, I think what I'm hearing is that, more than ever, and, the people watching us are very much keen investors who've taken ownership of their financial future. You've just got to stay close, keep as informed as you can, and respond as quickly as you can to some very unpredictable changes that lie ahead.
Yeah, I think I'd say that macro is very hard. Most people will say just stick to quality stocks because that will see you through everything. And I get that completely, by the way, because I think Microsoft will still be with us in 10 years' time or whatever. But it doesn't mean, they used to say that about the Nifty 50 and said these are the stocks. Not many of them are left, and they got absolutely hammered in the 70s. So, I've seen it all. I've seen all the trends, and the trend's your friend until it suddenly isn't. And suddenly it all changes, and I think you just have to be on top of that. But I don't think you have to change things all the time. I didn't change anything to the portfolio that I had. I did sell some credit in the very early days, but that's all. I've hardly done anything, and so I still kind of believe in that inactivity. But I'm watching for something bigger, a bigger change to the whole investing environment, and I think the virus could be the catalyst for that change in the next year or so. We'll see.
Okay, well, watch this space is clearly the message. Mark Dampier, Thanks very much for joining us.
Thank you, Graham.